Hey guys, welcome. Hey, just to make sure that you can hear me, I'm doing a mic check here. Got started about a minute late because I just looked down, my batteries weren't fully charged. So anyhow, if you can hear me, just throw a comment up that I'm coming through loud and clear. I'd appreciate that so I can see that. But other than that, once I see that you can hear me, we're going to get started on this because I don't show that I'm muted. It should be playing right through. John, I see you sitting right there. Do you know if you can hear me? Can you? Loud and clear. Awesome. Thanks, guys. All right. So what are we going to cover? We're going to talk about self-directed IRAs, solo 401ks, how you can use those in your real estate investing. To make sure that you're doing it the right way. And you know, it's a great source of funds. I'm also going to talk about how you can tap into those funds right now and access that money to use it possibly on the outside if you don't want the money trapped inside of the 401k or the gains that you're making on that. And this is an area that I've been a proponent of for a long time. And I feel that there's some misinformation out there, and it really has to do with the fact that the self-directed IRA industry is huge. I mean, there's so many people out there offering that type of product, so it eclipses the solo 401k many times, which for most people I think is a better product or the better tool to engage with when you're investing in real estate in a retirement account. And you're going to find that out as we talk about what some of those options are and why I would consider that. But it really comes down to what are you trying to accomplish, where the money's being held. Because when we talk about a self-directed IRA, there's nothing magical about it. A self-directed IRA is an IRA with one noted exception, that the custodian allows you to direct your investments. They allow you to put your money into other things. So you're not stuck putting your money with Charles Schwab or putting it into equities. You can actually put it into alternative types of investments, real estate, private notes, tax liens and deeds. These are acceptable investments in a self-directed because you're the one making the call. And because of that, you know, these companies that offer self-directed IRAs, they charge a fee for them, which they should, because they're allowing you to do something with your money that the traditional brokerage house will not allow you to do because they don't make money off your money. Unlike a broker, they're making money off of your account setup and then maintaining the account for you. So it provides a very valuable service when you set up a self-directed IRA because you're able to take your existing IRA funds and roll them into this self-directed IRA account. And it's important that you do that if you want to use an IRA. You do not make investments through your traditional IRA in this manner, because if you do, it would be considered an early distribution. And there have been cases where individuals, I know of one where it was a Charles Schwab account and he took money and he loaned money out to a third party, unrelated party, and then the money got paid back with interest, but they held that to be a deemed distribution because it violated Schwab's IRA. So keep that in mind. When we talk about IRAs, it's just like 401ks. These are agreements. They're trust agreements. And you can write into your trust agreement whatever you would like as far as what the controls are. Now, I do like solo 401ks better. If any of you are familiar with a 401k plan, because you may participate in one at your work or you have in the past. Now, when we talk about 401ks, many times people think that they're very restrictive. That's not the case. When you set up your own solo 401k, you can give yourself as much latitude as you want. I mean, solo 401ks, you can go way out here to the fringes when you're creating the plan, or you can get very narrow with what options you provide the participants in that plan. Because in a solo 401k, what you have is, let's say, here's my, let me go to color here. Here's my solo 401k plan here. What you're going to have is a trustee, all right? Trustee, and that's the person that controls the plan. And then you're going to have a participant down here, all right? Those are the people that participate in the plan. So you've got both there. So when I set up a solo 401k, I'm going to be my trustee, and I'm going to be a participant in this plan. And typically this plan is going to be sponsored by an entity. So you may have a corporation down here that sponsors the plan. Or you have an LLC, or maybe you're a sole proprietor and you set it up that way. So whatever sponsors the solo 401k plan is going to determine what types of provisions are going to be encapsulated into that plan that will be available to the participants. So just think on this. Your existing 401k plan that you have, if whoever your employer is, they don't allow you to invest in real estate. They won't allow you to take your money out at any time out of that plan. They put restrictions on what you can invest in. Why do they do this? Ease of administration. It lowers their costs. Where you invest your money with your 401k, be it through this third-party administrator, whoever's administering your plan on the financial side, they make money off your money. So that makes it less expensive for the employer. At Anderson, we have over 220 employees, and we offer a 401k plan. And we're really restrictive on what the employees can do with it. Again, it's for our own protection as well. If we just said, hey, guys, go out and you can invest in real estate, you can do anything you want, and they screw it up, they could come back and sue us. Because the way the law is written, they say, well, you shouldn't have given your employees the ability to invest in alternative investments with their retirement funds. Yeah, they screwed it up, but we're going to hold you accountable because you just cost them their retirement plan by giving them that type of control. It's counterintuitive. They're going to make me responsible for the mistakes that another person makes, but because they're going to hold me accountable, I'm not going to allow people to make those mistakes, and we're going to keep them in a very narrow, confined investing band. Well, when you set up a solo 401k, it's just you. So the only person you could sue if you screwed up with your investments is yourself. And heck, if you want us to, we'll represent you on that. We'll represent you on both sides. My partner will represent your company that you'll sue, and I'll represent you, and we'll just go at it. So this with a solo 401k, when you create that plan, you're going to draft that so you can invest in all types of permissible investments. You can roll in and out of the plan. You can do all this stuff. You can borrow from it at any time. And we're going to talk about this as well. You can have multiple loans out. So there is a difference when you're using this type of plan. Now, the difference in funding between a solo 401k and an IRA. With an IRA, the contributions are going to come from you on an annual basis, right? You got to have active income to put it into your IRA. And if it's traditional IRA, you're going to get a tax deduction for it. If it's a Roth IRA, you don't get a tax deduction for it, but when you pull it out, it's going to be tax-free. With a solo 401k plan here, the contributions to the plan come from a couple different sources. One, they come from you as a participant. So if your business is paying you an active income, you can make an employee contribution to your plan. This is called an employee contribution. Many of you, if you've had a 401k, know what I'm talking about. You contribute money to your plan. And then the employer, which would be your business, or if you're sole proprietor, they can make a match, so you can have a match from the employer on top of that. You can also set it up, and this is the way we set up our plans, that the sponsoring company can also make a contribution to the plan as well for the employee. We set ours up with a 100% match. So if you were making $30,000 in salary, then your company could put in $30,000 into your plan on your behalf. So you can really juice this up to $57,000 a year inside of a solo 401k plan. Huge amounts of money can go in there relative to a traditional IRA. But there's other ways to fund these plans that a lot of people like to use, and that is the rollover technique. So provided you're not talking about a Roth, because we can't do this with a Roth IRA. We can only do this with traditional IRAs. Many of the individuals that we work with, they will initially have a business entity or maybe a sole proprietor. We will then set up a solo 401k plan for them, like this, and we will take their traditional IRAs that they may have over here. Or maybe you have a 401k with a prior employer. See that? And what I mean by a prior employer is that if you have a 401k with a current employer, typically their plan will not allow you to roll out until you separate from service, because they don't want to lose those funds. They want to keep them inside. And then they only allow you to roll out at certain times during the year. Again, lowers the administrative burden of running that plan. Your plan, no such restrictions. Move in and out anytime you want. We don't care. It's you can handle this all on your own. So anyways, the way you set up a solo 401k, to do this, you establish the plan. You're going to be the trustee up here. So this is you. If you have a spouse, it could be both of you as a trustee of your plan. And you get an account opened up. Now currently we open up all our accounts with Charles Schwab. So we're not using Charles Schwab plan, we're using our plan, which is, there's a distinction here. If you open up a Charles Schwab account for your 401k and you choose to use their 401k plan, you can only invest in equities. When you open it up with our plan, and there's other people out here that provide these plans, I'm just going to use it in this tense. We then open up a Charles Schwab account under our client's plan. So then with this account, they have a checkbook. So they have that checkbook control, and then they roll their IRA monies into the solo 401k. So now your IRAs get rolled into there. Now remember, it can't be a Roth, but traditional IRAs are now rolled into this plan. So now you have this pool of money here. Now, if you have a spouse or a business partner, you can combine your funds into one account. It's called a pooled account. Now, the reason why people like this option many times is because if they've been using, say this is my wife's account and this is my account, and we want to do larger deals together, we've had to go and either create what's called a tenant in common to do a larger real estate deal together, or you create an LLC, and we'll discuss that here in a minute, to do that because we have funds in separate accounts. But when you set up a solo 401k, you don't have to go through those hoops and hurdles any longer, because all of the funds are held within this one account. So the investment gets made out of the solo 401k account directly. And then internally, you'll keep track of who has what balance inside of that plan. Maybe 60% came from me, 40% came from my wife, so it's a 60-40 split on all gain and income. So those calculations are run internally by you, because this is your plan, you're in control, you're the trustee, you're keeping it all together. Now, if you heard me say something there, you get a checkbook. So when you set up a solo 401k with Schwab, the way we set it up, Schwab actually sends out a checkbook to our client that has established the plan, and they're the authorized signer on that account. And the reason you like that is so it gives you the ability then to make alternative investments. You can just write a check. You can also wire the funds. But this is what we mean by checkbook control. So the solo 401k plan is slightly different than the IRAs in that you can pool the funds together. But you're going to notice there's some other differences as well with this plan. Now, how do we go about and use it for investing, be a self-directed IRA or a 401k? And this is where I think a lot of mistakes sometimes get made. I've run into a lot of individuals who have self-directed IRAs just like this, and they will actually own real estate in their self-directed IRA. It's like that. They'll have a couple homes in there. And then maybe they have 60K sitting down here on the side. Now, the problem with this strategy, of course, is that this is your retirement plan. And if you're doing this and you're putting that money or that real estate into that IRA, the mistake that so many people make is they think that the IRA offers asset protection. It doesn't. There is zero asset protection with an IRA. The only protection you have with an IRA is from outside creditors. That is, if you get sued. Now, that doesn't apply in all 50 states. There are a handful of states, I think there's about 10 states, that if you get sued, you can still, your IRA can be taken by your creditor. I love California's law on IRAs. They state your IRA is protected only to the extent that the court believes you have enough for retirement. Everything else can be given to a creditor. I mean, that's somebody determining how much you need when you retire. So this is a mistake for a couple different reasons, right? If you had a problem with this one property right here, you'll lose this property, you could lose this property, and you lose that 60K inside of that one account. So what you should do if you wanted to minimize the asset or minimize this overall structure is you could create multiple IRAs. So you could have a plan that looks like this. You could have separate IRAs. This would be one way to give yourself a modicum of protection. And see, I'm going to draw 4 up there. Even though I had 3 properties, I'm drawing 4, and here's why. Because you'd have a property in IRA number 1, property in IRA number 2, property in IRA number 3, and 60K over here. So now we've separated them all out. So if anything were to happen with this property right here, then the only thing that's going to be at risk is this property inside of this one IRA. Although, depending on the aggressiveness of the creditor, they could look through the IRA and hold you personally liable as well. There is no federal asset protection for them to look through. So because of this concern, and I see people make these mistakes many times, they just put many properties in one IRA, the preferred way of doing this should be as follows. You set up, if you're going to go with a self-directed IRA route and you're not going to use the 401k, or maybe you just have a Roth and you have to do it this way, you should always create a limited liability company, an LLC. If you watch some of my other videos, you know I talk a lot about LLCs and asset protection. And what you're going to do here is you're going to have the LLC owned 100% by your IRA, and you are going to be the manager of this LLC. Okay, so you're a manager. Now, a lot of IRA companies refer to this as a checkbook control IRA strategy, and the reason they do that is because they will put all of your cash up here into that LLC bank account. And the benefit then by having all that cash there is you can buy real estate. Well, the problem with this type of strategy is that if I had an IRA with $400,000 and my IRA custodian moved all of it into that LLC, and I went out and I bought 4 properties at $100,000 a piece inside of that LLC, I'm back to this scenario again. I've got 4 properties in one LLC. If anything goes wrong with one, everything's at risk. So you got to be careful on how you structure it. LLCs should be used inside of an IRA, but just because you're using IRA money, you shouldn't change your asset protection. So you may want to set up a structure where you have several LLCs like this, and then limit the amount of properties you're putting in each LLC. So I'll have 1 property here, 1 property here, 1 property here. This really comes down to your risk tolerance level. Some clients will put 2 or 3 properties. That's up to you. I'm just showing you, the best scenario. So we always go through good, better, and best. This would be the best way to ensure that you're minimizing your overall asset protection, your risk to the greatest extent as possible. And then all of them are owned by this one IRA. So collectively here, you pay no tax provided it's not leveraged, and I'll get into that in a moment. But all of it then flows down to the IRA, and the income, as I stated, is going to be tax deferred, or if this was a Roth, it's going to be tax free. So you want to use LLCs in this scenario. Now, what you don't want to do is try to set these up on your own. That is a mistake that you can make, because you could possibly run afoul of the prohibited transaction rules and when you're setting these up. So you want to have somebody create these companies for you. They'll set them up with you as the manager. Once they're set up, you're the manager. You can get the bank account set up, and then you can run the IRA and you can deal with the property. But the setup should not be handled by you. So IRAs, this is how I would protect my assets. If I was going to invest in rental real estate through an IRA, I would definitely set up an LLC to do it. You could also use a series LLC as well. So if you're investing in Texas or a state that Oklahoma that recognizes the series LLC, it doesn't have to be a bunch of separate LLCs. I set one of these up just this past week. We established a series LLC up here. And if you're not familiar with the series, check out my YouTube channel. I've got about 4 videos, I think, a series on series LLCs. The LLC is owned 100%, the master, the parent, is owned 100% by the individual's Roth IRA. And then I created separate cells like this, and all of these cells are owned by the parent. And then his Texas properties that he's buying are held in these independent cells. So now we're only talking one IRA, one LLC. Here, the parent, and then all these cells hold separate properties. So you can use the series as well with this type of strategy. You're not limited just using a traditional IRA. Now, if you're going to go the solo 401k route, okay, if you want to go this route, same thing. When you're buying your real estate, set up LLCs like this for your real estate, all owned 100% by your solo 401k. Keep your cash down here and your properties up here. Do not commingle the cash and the properties, because that's your investment money right down here. And again, if anything goes wrong, you would lose it. And I often tell people, think on this way. If you had $500,000 in your savings account, would you set up an LLC, buy a $75,000 piece of property, and put the remaining $425,000 in that same LLC? No, you wouldn't, because you can appreciate the risks there. So why would you do it with a retirement account? Because these funds are tax deferred for you, so that you don't want to risk them this way. Now, covered the basics here. There's a question Don wanted to know. He said, I thought the company match is 25% on the employee salary. So Don, with what I drew for you, it's actually 100% match up to the full amount of the contribution that you're allowed inside of the plan. The 25% you're referring to, Don, refers to the deductibility of the amount. So if I paid an employee, say I paid myself $30K, and I put in $30K into my plan as what we call a profit sharing contribution on that second side that I just showed you, then only 25% of that contribution would be deductible. So that's a good point that you brought up. It only has to do with deductibility. Okay, now, the other thing I want to talk about is to really delve in here is how to use these accounts to partner. So you know that you can partner with IRAs, with other IRAs, with yourself, and the way you do it is as follows. So if I wanted to buy a piece of property and I have an IRA and somebody else has an IRA, your option number one is to do a TIC, right? A tenant in common, where you own this property together, and then the property would be titled in the name of this IRA and in the name of this IRA, taken based upon your various contributions amount to buy the property. Now, obviously, that's not the best way to go here. So ideally, what you should do when you're partnering is set up a limited liability company if you're going to partner between IRAs. So maybe this was your Roth IRA here, and this is your traditional. You can do this. Both of them would go in, and then they would own an ownership interest in that limited liability company. If you don't want to bring in an, say you only have one IRA, you have a Roth IRA, well, you could do this then. You could go in individually. You could partner with your Roth IRA. It's all a numbers game here. So if this house that I'm going to buy is $100,000 and you're paying cash for it, if I'm bringing in $70,000 and my IRA is bringing in 30, then the LLC is going to be set up 30% to the Roth, 70% of the profits to me personally. So whatever those contributions amount are, that's how you're going to establish the ownership percentage in that limited liability company. It must match the contribution amounts that are coming from the members. And when you do this, this LLC is going to have to file a 1065 tax return. You're going to want to file a partnership return for it. Now, there may be some CPAs that might tell you that you could get around that by filing. I don't agree with that. I would still file a 1065 for that LLC, which means this, that your IRA here will need to get an EIN number. Make sure your IRA has an EIN. Sometimes the IRA custodians will apply for this and obtain it for you. If they haven't done that, then you're going to need to obtain an EIN for that IRA so you can report it properly on the LLC's tax return, which is the 1065. Now, from an asset protection standpoint, what you have then is if anything occurs inside of this LLC, then everything stays inside of that box and it's protected. On the outside, you're going to be protected as well. So when I drew you here investing into that, it doesn't have to be you. Maybe it's a Wyoming LLC that you've set up that holds your investable cash. For example, all my money that I use for my investing, until it's being deployed, I keep it in a Wyoming limited liability company. So I keep this cash amount there, and then as I need it, I deploy it from there. So you could invest through a Wyoming LLC that has your cash, and then you, of course, own that LLC. So I'm just trying to give you some options that you understand. And it doesn't necessarily mean it's you personally going onto that red box. It could be you through a different color box. It could be a corporation. So yes, you can partner with yourself in an IRA. And so what My Life on the Beach is asking me right now is they said, I thought there were restrictions, related party restrictions. There are, and I'll explain those in a moment. But in this type of scenario, as long as you are doing it, at arm's length, and you're not giving yourself or your IRA any personal benefit, which might be as follows. Let's assume that I'm putting in 70K, I'm putting in 70K and my IRA's putting in 30K. But when I draft the operating agreement, I indicate that I'm only going to own 5% of the LLC and my IRA gets 95%. Now you can see why somebody that thinks they're very clever would want to do this, because 95% then of the gain flows into their Roth IRA that they take out completely tax-free. They put in the majority of the money to buy the property, but they're only taking back 5%. In that situation, you're personally benefiting your IRA if you structure it that way. That's why you have to make sure that it's consistent with the capital contribution that's made to this company. So you can partner with your IRA, you can partner with other IRAs. What I just showed you earlier, if you have traditional IRAs, if it's you and your spouse, you could do the same thing. You could have your IRA here, self-directed IRA. Your spouse could have her self-directed IRA, and you guys could go together through a limited liability company. And there's no limit. I mean, you can have multiple LLCs structured this way. But if you're going to do that, I think you'd be better off setting up a solo 401k and rolling your traditional IRAs into the solo 401k, because if you go this route, and I've seen this done a lot, each of these file a tax return. So now you're spending additional money on an annual basis that you don't have to, and that could invite scrutiny. And if the IRS starts looking, depending on what happens with the election in the fall, if the administration changes, or the Senate would be more my concern as well, changes hands, you're probably going to find more scrutiny of IRA transactions like they did 4 years ago. Where when the Senate was controlled by the Democrats, Ron Wyden on the Senate Finance Committee, this was one of their pet projects, was looking at self-directed IRAs. In fact, they changed one of the reporting forms to specifically require IRA custodians to list out if the IRAs themselves own interest in LLCs, land trusts, corporations, real estate, private notes, tax liens and deeds. They want to know how many transactions were made in the IRA. So they just really drilled down on real estate investors. It's Form 5498. Your IRA custodian prepares this on an annual basis and submits it. And so using these types of accounts, it could draw additional scrutiny. So what I would do to protect myself or minimize that risk is set up a 401k plan, that solo 401k, and then roll these two accounts into here. Now you get the money in here. It's no longer a partnership scenario again. Now it's just a direct investments into your LLCs that you create. So when you make that direct investment into the LLC has one member. Because it only has one member, it's a disregarded LLC and it does not have to file a tax return. Whereas in this case, we were filing 3 tax returns. This case, we're filing no tax returns for those 3 LLCs because they have one owner. So that's why I would like to utilize this type of structure with this. And of course, you can also partner with your 401k plan. Just like everything I showed you with the IRA, you can also partner with your 401k. Now, I don't know if you caught my other video on using debt inside of the plans. Now here's where the things get more tricky for individual investors. I mean, one of the things that we're taught as real estate investors is OPM, right? Other people's money. Use leverage. It's going to increase your cap rate on properties when you leverage down. And then you're not tying up all your cash into one deal. You can go out and buy more property. Well, if I have money in an IRA, there's nothing that prevents you from utilizing debt inside of your IRA. You can actually use leverage in an IRA. You can also use leverage in a 401k. The main concern is that if you're going to use debt, that debt be what we refer to as non-recourse, which means this: you do not give a personal guarantee, or a disqualified person, which I'll show you in a moment who the disqualified people are, cannot give a personal guarantee for that asset. So as long as you're not using personal guarantees and the lender can only look to the property itself, if you default, then it's okay to do. And leverage is great inside of retirement plans from the standpoint that you can then do more with your money. I find a lot of investors will go all in with their cash. If they have an IRA set up here and it has $400,000 and they're buying properties at $100K each, they're going to buy 4 props. And they'll have 4 props like this held probably like they should in LLCs. Boom, boom, boom. Now, you've just deployed all of your money. Whereas a more experienced or savvy investor would look at that and say, all right, typically if I'm going to use an IRA and I'm going to go for non-recourse financing on an investment property, I'm going to need at least 30% down. So if I need 30% down on a $100,000 home, that's $30K. So how many properties can I acquire with $400,000? Well, you do the math there, it's going to be what, 13 homes you could buy with that. So now, rather than having 4 properties, you have 13 properties that you invested using debt inside of your IRA. So if you start looking at the numbers here, the potential for wealth accumulation starts to really grow when you're using leverage inside of this account. But the problem in using leverage inside of an IRA, and this applies to Roth IRAs, is what we call UBIT, unrelated business income tax, or unrelated business taxable income. People refer to it both ways. And the way UBIT works is like this. If I'm going to leverage up, and also think on this if you're a syndication investor. If you're going to invest in syndications, you have to be aware of what the implications are with UBIT. So if I'm going to invest into this deal, I'm going to buy this house, and I'm putting in 30%, okay, and I'm going to borrow 70%. So this is the debt portion. This is my contribution from my my IRA. So if that's what I'm doing to buy this $100,000 house, 30/70, then UBIT requires that 70% of the income generated from this asset, be when it's sold or the rental income then, is taxable. So if the property generated for me on an annual basis, let's say it made $24,000. Seems a little bit high for a $100,000 house, but just go with me on this. Let's just go 20. If it made $20,000, then 70% of that would be taxable, or $14,000 would be taxable to the IRA. Now you get your depreciation, you get all your deductions, but the point is that as you grow this portfolio, if you go back to my example with 13 properties, there's going to be income there. And that income is going to be taxable. And the tax rates on IRAs with UBIT, it's 37% at about $13,000, $14,000. So you're going to pay tax on income the IRA is generating. The IRA pays the tax. You don't get a credit for that when you pull the money out. If it's a Roth, your Roth will pay the tax. So when you want to use leverage, herein lies the problem. The leverage can create tax liabilities for you. So if you want to avoid that, then the preferred method is to set up that solo 401k plan and leverage through the solo 401k, because the solo 401k is not subject to UBIT. So you can go out there and invest through this, leverage up, have the 13 properties, and you won't get tagged with that tax. So that's an area where if I'm talking to an investor, I'm going to tell them if they want to invest in this, you want to go with the 401k over the IRA if you ever plan to use debt. So John asked me this question right here. How do you use an IRA or 401k with a Wyoming LLC to reduce or eliminate capital gains and create asset protection? Okay, so with a Wyoming LLC, you're not going to utilize it with this solo 401k. It's not going to eliminate any type of capital gains per se. What's going to eliminate the capital gains is that the fact that the investment is made inside of the solo 401k. So when I set up an LLC here for my solo, if I bought a property in Florida, this would be a Florida limited liability company, unless you wanted the anonymity. If you want the anonymity, then I would set up a Wyoming LLC owned by the solo, and then it would own my red boxes. Oh, you can't see it on the screen. It would own my red boxes like this. And this would be the Wyoming entity right here, John, and then it would all flow back down into the solo 401k. So what's eliminating the capital gains tax is not the solo. It's not the Wyoming LLC, it's the solo 401k. That's what that's doing for you. And the only reason why you're using that blue box in this scenario right here is for anonymity. If you're not concerned about the anonymity, then you wouldn't need to use it. In fact, when you set it up in this scenario, since all these would have to be manage or manage, if you didn't want that, then you would want to definitely, if you wanted the anonymity, you want to use the blue box and make them member managed. Okay, that's a good question. Here's another one I'll take here. It states from Mike, what if you buy a house to live in? Can you still use the solo 401k? Okay, great question, Mike. I'm going to come to that here in a little bit. You can't invest directly in the solo 401k, but we'll talk about how you can get the funds so you can buy that house here in a moment. All right, so with these plans, you have the ability to partner inside of them, or like I just showed you, or you invest and you can use leverage. I did say that there was an issue with retirement accounts and knowing who's a disqualified party. So you have to be aware of that. So let me just bring up this scene right here. So hopefully you can all see this. So here are the disqualified parties inside of a retirement plan. So if you have an IRA or 401k, the people in red or the entities listed in red are disqualified parties. So that means you cannot engage in a transaction with your retirement plan and any of these individuals. So I couldn't use my parents, couldn't use my grandparents, my spouse. All of this would not be permitted. So it's pretty much lineal here. Now if you jump over here, looking at if you had a business set up, an LLC, we also have things we need to worry about here. Officers or directors are disqualified people. 10% or more partners in a business is a disqualified person. So that would be an entity you're investing in or sponsor of the plan itself. So these are the disqualified parties. Now, here are what some of the prohibited investments. The way the code is written when it comes to what you can and cannot use your money for, it's primarily written in a way, or it is written in a way that tells you what you cannot invest in. That's why when people tell me, well, that's not permitted. And so show me in the code where that investment is not permitted. And the investments you cannot engage in, of course, is going to be life insurance. You can't invest in life insurance. However, in a 401k, you actually can invest in life insurance. You just can't do it through an IRA. There is an exception. Even though 4975 states that insurance is not a permissible investment, I forget the section that deals with 401ks under ERISA. You can actually buy life insurance on your life inside of a plan. Collectibles, works of art, metals, gems, stamps, coin, drugs, things like that, alcohol. There goes my wine collection, right? I can't use my IRA money for that. And then foreign investments. So they restrict investments to the continental United States. So those are the prohibited investments. That means everything else is available. Now, given that, you also need to understand that these are prohibited transactions. So just because you can make an investment into something like a piece of property, they then restrict how you deal with that investment. All right, so for example, you cannot personally benefit, and I already talked about this, from a transaction involving a plan. There was an individual I worked with several years ago. She was a realtor, and her husband, she set up a plan. We set up a solo 401k plan, and they were investing in real estate. Well, she then started listing those properties for sale after a number of years, and then was taking a commission when the properties were being sold. And when she told me about this, I said, why would you do this? You can't engage in this type of transaction. That is a prohibited transaction. And then she went into panic mode about this. And I said, don't worry, okay? You were doing it through a 401k. If you were doing it through an IRA, I'd be really concerned. So if you made a mistake with an IRA, what I tell people, shut that IRA down, roll into a new one, make it go away. Why do I tell you that? Because when you engage in one of these prohibited transactions, you disqualify your IRA on that day that you made the disqualifying move in this PT scenario here. So if you did it through a 401k plan, which is what they were doing, it does not disqualify your 401k. If it's caught on an audit, you just have to pay a penalty tax on it and then put the money back into the plan. So there's a big difference when it comes to how these plans are administered when you make a mistake. One mistake in an IRA, I always say it's one and done. One mistake with a 401k, no problem, you just pay a tax. I've never seen a 401k plan disqualified and shot down over mistakes because ERISA protects them. And there's a couple court cases out there, and I don't know if I've talked about them on my YouTube channel or not, where individuals engaged in certain transactions. There's one situation where a guy went bankrupt and they found that he'd engaged in a prohibited transaction with his IRA, and so the bankruptcy trustee took all of his IRA funds from him, even though the individual participant or IRA owner tried to argue his IRA was protected in bankruptcy. And the court said, ordinarily it would be, but because you engaged in that prohibited transaction 3 years ago, you lost it. And then you come out to California where a guy had a solo 401k plan set up, and what he did is he built a house. So was it John that asked me about or Mike asked me about building a house? He bought a house actually inside of his 401k. He moved into it. He bought a boat so he could water ski because the house was on a lake. He engaged in a transaction with his daughter, prohibited or disqualifying party. He did all this stuff, and then he filed bankruptcy. Bankruptcy trustee went after him and tried to take his 401k plan. Court held, listen, doesn't work that way. If it was an IRA, you could take it, but 401k is covered under ERISA. And in that situation, the only thing you can do is hit him with a penalty tax. So so there's a lot of benefit to using the solo 401k if you're making a mistake. But as you can see here, you can't guarantee loans made to the plan. You can't enter into transaction with IRA owners. The other thing I see with real estate is that people add value to the investment. For example, you can't go out, if you're going to rehab the house, you can't do the rehab work yourself. You cannot live in the property. So you can manage it, but you just have to treat it as if you're managing an investment. You can't actually be out there the one doing the work. Sometimes, there are exceptions as well. People aren't aware of this, that if you're in the middle of rehabbing a project and all your funds are used up and you have property taxes are due, there's exceptions where the owner, in a solo 401k participant or an IRA owner, can actually loan money to their own plan to cover that property tax or certain types of investments. And then as soon as the funds are available, they have to pay themselves back right away. And that won't disqualify your plan. But it has to be something like that. It can't be, well, my IRA needs another $50,000 to build out a bathroom, a couple bathrooms. That would not work. But if it's something germane to the underlying asset itself to maintain it, then they offer exceptions to it. So these are the prohibited transactions here you got to be careful of when you're dealing with the plan itself. All right. So what else can we do with these types of plans? Well, if you don't want to just invest in real estate, you have other options. If you had a plan set up, this works either through a self-directed IRA or a solo 401k, it doesn't matter. You could loan money, so you could engage in private lending. So if you wanted to lend against a property right here, you could take back a deed of trust on that property. So you can engage in private lending with your plan. If you want to invest in tax liens and deeds, you can do that as well. Typically the way you would do that, or maybe even buy properties at auction, you're going to want to set up an LLC that's owned by that, and then you would invest through the LLC. I find that it's easier to do it through a limited liability company than it is directly through the plan. And the reason I say this is that sometimes when you're dealing with third parties who are not accustomed to dealing with these types of owners on tax liens and deeds or real estate at auction, it throws them off and they may not allow you to close in the name of that. So I always say just set up an LLC and make your investment through there. Syndications. You can invest in syndications directly through your solo 401k. If you did it through the IRA, the concern that you have is that UBIT that we talked about earlier. Most syndications are leveraged at 70%. So 70% of your income, 70% of the annual income, 70% on the liquidation event is going to be taxable to your IRA. So you got to be careful there. If you're currently in that situation and you know that you've got a liquidation, a capital event coming up, you may want to get out, roll out of the IRA, roll into the 401k and hold that through that capitalization event so that you will not be taxed out of there. All right, so you can invest in syndications, you can lend, tax liens and deeds, pretty much anything you can think of. One issue that does come up is wholesaling, all right? So if you want to wholesale, could you do that through these types of accounts, be it a solo or a IRA? I tell people you should not wholesale through these plans. And the reason why is that wholesaling is really income that is derived through your efforts, right? Things that you're doing. So it's like it's considered active income too if you're to do it in your own name. And because of that, it's not per se an investment. Solo 401ks and IRAs cannot engage in an active trader business. If they do engage in an active trader business, then you're subject to UBIT, which, it's not the unrelated debt financed income, the UDFI that we talked about, but it's another aspect of UBIT, which means that your IRA will be taxed on those gains. UBIT also applies to a solo 401k. I think I put UBIT, I didn't put UDFI. The debt finance one is UDFI. That's unrelated debt financed income. That is what does not apply to a solo. UBIT does apply to the solo 401k, and that's when your solo is engaging in a business. So if you're going to wholesale, that's going to be a problem for you if it gets caught. That income will be taxable, and it's going to be taxed at the same rate as the IRA. So the active strategies, flipping property. Could you flip? Yes, you can. But if you're going to engage in flipping full time, well, that could be an issue for you, because now you move from something that looks like an investment into an active trader business. Where you can really get into problems, I think, is that if you've set up a company that sponsors this one. So here's my corp down here. What is the business purpose? Flipping. What are you doing up here? Flipping. All right, you see, hey, I'm doing a business down here, active trader business of flipping, but it's not an active trader business when I do it through my plan? Probably not. They would look at it to be the same. So that could be subject to UBIT. But if you wanted to do that and push the envelope a little bit, definitely don't do it through a self-directed IRA. Do it through a solo 401k, because the audit rates on those are practically non-existent. The only times I've ever had a plan audited, and we've done thousands of plans, have been where people have made an investment into foreign security. On the local side, domestic side, never seen the audits come through. But on those cases where they went outside the United States, that triggered the audit, because that has to get filed on their 5500. So you can do a lot of investing types of investments through there. It's really up to you. Here's a question right here. Somebody said, thanks. It seems like you don't take the commission. Yep. You keep mentioning ERISA. I was under the impression solo Ks are not governed under ERISA protection. Chris, you're right. So when it comes to solo 401ks, they're still governed by ERISA. It's just that when they talk about the asset protection feature of the solo 401k vis-a-vis your personal creditor, can a personal creditor get after them? So there's a distinction there when it comes to the solo 401ks, how ERISA applies to a solo versus an IRA. Somebody asked me here, said, would you then, if you want to sell the property and you're going to pay a commission out of your IRA, then it would have to be someone who is not a related party, and that's correct. Now here's a great question from Tango. Don't you have to have to give your name to open up a bank account? So if you lose your anonymity, similarly when you buy home insurance on your property on your LLC, you have to give your name. Absolutely. When you're using the anonymity like I described here, the bank's going to know who you are. There's no way you can open up an account without giving up your anonymity. I mean, you could try. You could walk into a bank and the bank says, who are you? None of your damn business, but I want to get an account open. Well, what name should we put it under? Put it under no one. Okay? See where that's going to lead to? You're not going to get anywhere with that. So you're going to have to disclose your identity. I don't know, who knows under COVID now? Maybe you walk in wearing a mask, they might accept it. But the point is that you do have to disclose that, but that isn't going to be made public knowledge. So it's only between you and your banker. On your checks, it does not have your name on them. Yes, you have to sign the checks, but I don't know about you. When I sign my name, this is how I sign. Okay? No one knows who the heck that is when I sign the check. So it's what is going to be on the check itself will be the entity name. But it's a good question. Comes up. All right, now this brings me to another point of these plans that I like. So if you know about with the solo 401k, you can borrow from the plan. With an IRA, you can borrow, but you have to repay it within 60 days. Now, under the solo 401k, you have greater latitude, especially under CARES. So if I have a solo set up here and I roll in $200,000 into my solo, just me. If I have 200K in here, I can borrow out now $100,000 under the CARES Act. This comes out as a participant loan. So here's the way it used to be. And it's going back to that on September 27th. So if you want to do something like this, you have to jump on it ASAP because it's a limited time window for what I'm about to share with you on this particular deal. So currently with 401k plans, and you know this if you have one, you're allowed to take out a participant loan. A participant loan is limited to 50% of your vested balance, not to exceed $50,000. So if you had $70,000 in a 401k plan, the most you could borrow out is $35K. That was pre-CARES. So that's 50% of my vested balance. If I had $200,000, then the most I could borrow is $50K out. Now, when you borrow this money out, you have 5 years to repay the funds. So you pay it back to yourself. Typically, the rate's now about 4%, 4.5% interest you're going to pay yourself back at. Okay, is how we structure these. Now, under the CARES Act, they increased the limit from $50K to $100K up to 100% of your vested balance. So if we went back to this initial example I gave you with $70,000, if you had $70,000 in your 401k plan, you could borrow out $70K. And rather than having 5 years, you have 6 years to repay, and you get 1 year free of no repayments. So first year after you take out the money, no repayments. And then after the next year, that's when you have to start repaying the funds back to your plan. So going back to my 200K analysis again, if I had $200,000 and I rolled it into my solo 401k from my IRA, I could borrow out $100,000 provided I take the loan prior to September 27th. So I got to get that money out. So that would then leave me with $100,000 left in my plan. Well, guess what you also have? You have the ability to take out a COVID hardship distribution. Your COVID hardship distribution is up to $100,000. So I could take out another $100K. Now with the COVID hardship distribution that I pull out of the plan, you have to pay it back by the end of the 3rd year after you've taken it back. So by the end of 2023, that money has to be paid, or no, 2022, it would have to be paid back into the plan with no interest. So the money goes back in, you don't have to pay any interest. Under this one, because it's a loan, you do have to pay interest. Under this one, because it's a hardship distribution, you don't have to pay interest. Now, there are a number of commentators out there that have stated that you have to pay tax on this ratably over the 3 years. Incorrect. That is not what's provided in the CARES Act. The IRS may want you to pay the tax, but the CARES Act specifically states that you do not have to pay any tax. It's treated as a 60-day roll. 60-day rollovers are not taxable. There is no tax due. So you can gain access to $200,000 inside of your plan with this. Now let's say you were married and your spouse has $200K and that's inside of the plan. Spouse can take out $200,000 as well as a loan and COVID distribution. So you have potential now to pull $400,000 out of your plans if you had that much in there that you could use then to invest outside of the plan. Why would you want to do that? Well, you want to generate current income for yourself. So you're going to buy the properties, you can use that money to acquire the property so you generate current income. And then all you have to make sure is that you're plenty liquid 3 years from now to pay back the first $100,000. And then you've got to make sure you got enough liquidity to pay back the other note within 6 years. But I mean, simple enough to do. If you were to go buy these properties, refinance them out to pull the cash out to pay the loans back at a later date. Why is this something I would consider? Well, there are going to be opportunities that are coming up in the near future. And if you want to do it, then take advantage of that in real estate, and you don't want all that money trapped inside of your 401k, then I would look at pulling the money out now. So let me see here. There's a question. I'll go through these. Pop this one up. Nope, not that one, John. We already talked about that. Okay, how best to fund the solo? Bank account, rollover, traditional IRA, and what is the max contribution for 2009 and 2020? So if you want to fund the solo plan, typically the way people fund it is by rolling in traditional IRAs. If you want to go and contribute additional amounts in there, you have to do so from salary contributions. You have to be paying yourself a salary. So the sponsoring business, you need to be generating active income through it. So if you have your own business, flipping real estate, realtor, I don't know, whatever business you have, maybe you're a truck driver, as long as you have active income. The only thing you have to be aware of, though, is if you have employees, this isn't going to work for you, unfortunately, because you have to make your employees, they all get to participate in there. So let me go back to Chris. If you take out a 100K distribution, not a loan, from a Roth 401K under the CARES Act, I'm under 59 and a half. Oh, there's two parts to this here. And the funds have been there for more than 5 years. Is it a qualified or unqualified distribution? In other words, do I still have to pay income tax on it? Well, if you took out $100,000 that have been in there for more than 5 years and it's not gain, then it wouldn't be a CARES Act, would it? It would just be a return of capital. You have to leave the gain in there until you're 59 and a half, but you can pull out money you've already paid tax on. Why would I treat it as a COVID CARES Act distribution? Well, if I want to make sure that my plan's fully funded, once you take that money out of the Roth, you can't get it back in. So Chris, what I would do is claim it under CARES for that 3 years period, and then after the expiration of that, if you're thinking, I don't have the money to pay back, then go back and refile and claim it as a distribution. That's interesting. I haven't heard that. I hadn't thought about that one before. Thanks for bringing it to my attention. I see a little planning opportunity there for people if they have a Roth account to kind of play with that. I mean, when you're thinking about Roth, depending on where you're at income-wise this year, if you were furloughed and you know your income's going to be down, another planning that you should be considering is, should you be contributing or doing Roth conversions? Now, if you want to do a Roth conversion, you have two ways to handle this. You can take your existing IRA and do a conversion, or roll your money into a solo 401k. Because see, the solo 401k has a couple of different buckets here. You have this bucket here. This is from the employer. This is where the employer contributes money for you. You have down here, you have your 401k. This is employee. That's you. You put the money in. And then you have your Roth 401k here. Okay, that's where you put money in. That's non-tax deductible. So if you're going to put in money into your 401k account, you're going to decide which one you want to fund. So you have the option. Now, if I'm going to roll in IRA money that's not Roth, it's going to go into my account here, my employee account. So if I rolled in 100K, I could then do a conversion inside of my 401k plan. Because my income's down this year, I could do a conversion inside of there. Why would I consider doing that? Because I'm in a lower tax bracket. Now, by doing the conversion inside of the solo 401k itself, the benefit to this is that now those funds are in the solo 401k, so now you can engage in those other types of investing that I talked about that's not subject to UDFI. The money can be held in a pooled account. If you made the conversion outside of the 401k and you did it with the Roth IRA, well, now your money's going to be stuck. So what I've done in the past for people is that if they made a conversion at the beginning of the year, and they realize, oh, I didn't want to do that because I didn't want my money stuck in the Roth. I want it in a solo 401k. We undo the conversion, roll into the solo 401k, and then do the conversion the right way. the way it should have been done to begin with. So by setting the plan up in this way, you have those options. Which the other thing about this plan that you may or may not be aware of is that in a solo 401k, you've got, as I refer to it, as these 3 buckets. You can put money in, from your business that you're earning money from. You can put it in your 401k bucket, which is tax deferred. You can put it into your Roth bucket, which is tax free when you pull it out. Or you have your employer bucket that puts money in for you that, again, it's tax deferred. Well, you also have another bucket down here. And this bucket is an employee after-tax bucket. And what do I mean by that? Well, this bucket here, think of it as a non-deductible IRA. You can put money into this after-tax bucket. So it's money that you pay tax on, but you're still allowed to fund it into your plan to get up to that $57,000 total limit across all of your accounts, because that's the maximum that can go in. So think on this. You have a business right now and you make $120,000. And this year you put in, based on your age, you put in, let's just say we put in $18,000 into our Roth bucket. So now we got $18,000 in the Roth bucket. That was after tax, right? Because you did your 401k Roth after tax contribution. Now, I want to get up to that $57,000 amount. I want to get the full funding into my plan. So there is $39,000 that I could play with. If my business over here that sponsored it had the $39K, it could contribute it to my account for me. It could do that. But the problem with that contribution is that some of it will be tax deductible, 25% of it's tax deductible, but when I pull it out, it's taxable to me. So if I want to create a tax-free retirement for ourselves, I will forego having my company make the contribution, and instead I will make the contribution here into this after-tax bucket of the $37,000. So I'll put in the $37,000 myself. Okay, so now I have combined into my plan, I say, 39,000, right? 39,000, excuse me. I have combined into my plan the entire $57,000 for the year. That's what I'm allowed to do. I could leave it, but this is the one time in which I will typically tell people to roll out and put their money back in an IRA. And the reason why is this. Those funds that are held inside of that after-tax bucket, just like with a non-deductible IRA contribution, you'll never pay tax when you pull that money back out since you paid tax for it going in. But if you leave it in there and that money grows to $100,000, then you're going to pay tax on that $61,000 in gain if you left it inside of your solo 401k. Now, why would you do that if you could move that money and not pay tax on that $61,000? Well, it's because most people don't tell you this information. They have not shared with you that your plans allow for this type of deal. So the way you structure this is you set up a Roth, self-directed Roth IRA over here. And because your plan allows you to roll out at any time, it's not like your employer's plan that says you got to quit. When you set it up yourself, you get to roll out at any time. What you'll do at the end of the year is you're going to roll the $39,000 out and you're going to roll the $18,000 out and you're going to stick it inside of a Roth IRA. That's what you're going to do. Now you've got $57,000 inside of there. And you do that year after year after year. In 10 years, you'll have $570,000 contributed to a Roth IRA. How about your neighbor? What is he going to be doing? He wants to invest in real estate. He's just doing a traditional Roth IRA. He'll have what, 60,000 in there? You'd be looking at him going, how many deals you can do with 60K? I got 570. I'm on my way to my tax-free retirement. You got a long ways to go to get there. See, it all comes down to knowing how entities work, and that if you set them up the right way, they can help you do more and they can benefit you. And it's ensuring that you're capitalizing on every benefit that is there inside of the tax code. This provision right here, it came to me just as an idea, when we had our planning meeting, myself and my partners, Toby and Michael, were having our planning meeting. And we were looking at our plan and the way it's drafted. We knew what you could do with it. We said, I wonder if that money right there in that after-tax bucket, if you could roll it into a Roth IRA. We had no idea. We knew you could roll it into an IRA, but we just wondered, would it qualify? So we actually just Googled it, because we're sitting there in a meeting room together, and I just typed it in. I just hit Google, and my Google actually connects to a database I subscribe to with Wolters Kluwer for pension analysis and all this stuff. But that wasn't what the hit that I got. I ended up getting the IRS's website, and on the IRS website, it talked about these after-tax accounts, and it said it was eligible to roll into a Roth IRA. And the light bulb went off, and I said, there is a strategy right there. Now, I've taught this strategy for going on about 3 or 4 years, and I've only run into one person that has actually been utilizing it, and this was actually through their employer. Their employer not only allowed for this type of contribution, but also allowed them to roll out. So it's out there. It's hard to find, but if you set up your own account, you can do it on your own. So it's really, this plan is phenomenal on the things that you can do with it once it's set up. All right, so let me go back here, and there's some questions here that came in. LC wanted to know this. Any prepayment penalties on both the loan and COVID? There are no prepayment penalties. You can pay it back at any time. Patrick, I didn't think the CARES Act hardship distributions needed to be paid back. Only have to pay the tax on it over the next 3 years. Well, Patrick, you're right. Well, I don't know what type of fish that is. But the thing is, with these plans, if you don't want to pay the tax, then you pay it back. Yeah, there's no penalty tax on it, correct. You just have to pay the income taxes. What I'm saying is that rather than paying the income taxes, take the money out, make some money off it, and then pay it back. So it's slightly different. May wants to know, but what if the IRA is in stocks and I don't want to liquidate? Is it good to fund the solo 401k with rental income as a sole proprietor? Okay, so if you've got your IRA that's invested in stocks and you don't want to liquidate out of the positions, granted, then you're not going to be able to do a roll into a solo 401k. Then just stay there. Don't do it. But yeah, having rental income go in there, I mean, if you see the benefit of real estate, you know what it can do for you, then having real estate as another investment class, I think, is sound diversification for your retirement plan. Personally, I don't invest in the stock market. I used to. I made a ton of money in 1 year, and I lost it all in the same year in 2001, and I've never gone back. I use what's called an Index Universal Life. You can see some, I think I have a video on my YouTube about that alternate retirement planning strategy, so I never lose money in the market. Chris, why not roll it into the Roth portion of your 401k? Okay, because you're not allowed to roll it into the Roth portion, Chris, of the 401k. Actually, the IRS said you have to roll it out into an IRA. So that's why we didn't do that. And then at what level, after how many properties, shall someone start looking into these strategies? So these strategies, Tango, it's not so much about at what level, it's about, do you have assets in an IRA that you want to expand your ability to do more with them? That's how I would look at it. Or if you have your own business where you're generating income and you want to start sheltering some of that income, then I would look at utilizing this strategy. It's not for everyone. I mean, if you came to me and you said, listen, I have a self-directed IRA, it has a single family home in it. Should I set up a solo 401k? I would say no. Just based upon that, it's not worth it. Stay with what you have. It's working for you, don't change. But if you want to expand and what you can do with it and you have some cash, then I would consider it. We have moved real estate out of the IRAs before into solo 401ks. You just have to deed them. You can do this. Typically, the way I like to do it is first move it into an LLC, then move the LLC out. But it depends on the IRA custodian and what they're willing to do. Many times they don't like to give up the assets, so they kind of become, pain in the ass on this deal. So you got to fight with them to get your money out. But if you've made a mistake, so remember when I showed you what those prohibited transactions were? If you know that you've got an IRA that you screwed up because you painted the house, I know one individual I was working with, she was actually living in the multifamily, managing the property herself. Don't know what she'd do. I got an individual that I've worked with, has 60 properties in a Roth IRA. 50% of the people pay cash every month to him personally. and then he goes down and deposits it with the custodian. So if you're in one of those situations where you've really screwed it up bad, then I would consider taking those properties, rolling them into a 401k and shutting that IRA down. So that's when I would do it. Typically, I wouldn't recommend somebody close something out if it's been working for them. Here's another one from Lawrence. CARES Act, COVID, 100K pulled out. If you pay it back within 3 years and put it back into a qualified plan, no tax event. Can I roll the repayment 100K into a solo 401k to invest? Lawrence, so I don't know if you could roll that or pay that money back to the solo 401k. I think what happens is that you have to put it back into the IRA. It doesn't say, if I recall, that you have to put it back into an IRA if it came from an IRA. I'd have to go back and look at it. But again, that's a great topic. It's never come up before. I live in Oregon, John says, and I do an LLC and a 401k in Wyoming. Do I need a bank account in Wyoming? All right, perfect. This is a great question that comes up a lot. So if you have a Wyoming LLC, do you need a bank account in Wyoming? No, you can open up a bank account in Oregon. I mean, many of my Delaware LLCs, Oklahoma LLCs, North Carolina LLCs, I open them up right here in Tacoma, Washington at the local Chase branch. And I just give them a local address for the bank account. So you don't have to travel to Wyoming unless you want to go there. Jackson's a beautiful area. Does each LLC have to pay taxes each year, or is there a way to defer or eliminate taxes? Depending on how you set up your LLC, they shouldn't be paying any taxes. It's the owner of the LLC that picks up the tax because the LLC is a pass-through. So if it's held by a 401k, then there is no tax that has to be paid. You know, this coming up, not this weekend, but next weekend, I'm going to be teaching a class on this. I don't know if you guys made it out last time, if you saw it. I teach a one-day event with my partner Michael Bowman this time on real estate tax and asset protection. I'll be covering LLCs. I talk a lot about how you can benefit from a Wyoming LLC and incorporating that into the plan. You know, because there's different things. There's so many different things that you can do. I just spoke with someone today, 2 doctors, and one of the things that we're doing with her business, because of all our receivables and stuff, we have a Wyoming LLC, and we're going to be entering into a line of credit agreement between her business. So here's her LLC right here. We set up in Wyoming. Her name's not on it, neither is her husband's. She has her business over here in California, high litigious state, very concerned about the receivables and the equipment. We're going to enter into a line of credit here between the Wyoming LLC and the California business. And then I'm going to file a UCC-1 for that amount. So we're not actually moving money. We're just going to encumber it with $700,000 in supposed debt and then file the UCC-1. And the purpose of that is that if somebody wanted to come after her and they run an asset search, they're going to think her business is fully encumbered. I also call this strategy that I'll be sharing with people next Saturday at this event. So it's next Saturday. It's all day from 9 to 5 Pacific Standard Time. What I call my zero loss strategy, zero property loss strategy. You'll see when I'm going to ask people on the event, how many properties are you willing to lose in a lawsuit? Most people are going to put 1. Some people put 3 or 4, and I'll question them on that. Every once in a while, you'll find someone that'll put 0. Well, using a Wyoming LLC, you can then capitalize on your zero loss strategy by structuring it in a way. So it's a great event if you want to join. So if you want to know about anything about IRAs, you want to know about how to set those up, if you want to set up a strategy session, you can definitely check us out here. You can go to the aba.link/30-minute session. It's in all my videos as well. And we can then talk to you about a 401k if you want to know how it would work for you. Because I'll just tell you up front, this isn't for everyone. And so you'd want to sit down and talk with someone in our firm to determine whether or not it works in your situation, to see if it's better than doing the IRA. And as I stated, we analyze it and we'll probably tell you if you should do it or you should stay where you're at. So guys, thanks for coming on. I burned up my hour, went a little bit over as usual. And like I said, I hope to do more of these. I plan to do more of these in the upcoming weeks. If you've got any questions or any ideas for me, you know, send me some comments on it. I'm always looking for new topics for videos. you know, you can go on YouTube and you can do that public comment thing there that I forget, I don't know what it's called, where I posted this on. You can reply back to that. Things you would like to hear more about, I'd be happy to do that. Just let me know, and I'll be there. So with that, I'm going to have to check out for the day. Thank you for coming on. Enjoy your weekend, and I hope to see you next weekend. Take care, everyone.